Now let us turn to the equity method of investments. Remember, for an investment to be classified as such, we need to own anywhere between 20% and 50%. This is considered significant influence. Why would a company purchase another one on a 30% basis? Well, the reason is simple. If you want to make an alliance, you need to make the alliance real, where technology and resources are shared fairly and equally. For this to exist, you need to own shares in each other. The best example is Renault owning 43% of Nissan and Nissan owning 15% of Renault. If you own shares in each other, there is less incentive to mistreat and to take advantage of them because you own shares in them. In the first step, we purchase the equity security. Assume we purchase 30% of Microsoft for 100 billion. Our cash is less. We now have an investment on the balance sheet. The cash is classified under the CFI in the cash flow statement. Purchasing assets does not give us more income and does not make us richer. So the income statement and equity are unaffected. Microsoft declares income of 10 billion. We are 30% owners. The rules allow us to recognize income also as a proportionate holding of the investment. Since we own 30%, then we can recognize an income of 3 billion. We again do the mustache. Retained earnings are now 3 billion also. And net income on the cash flow statement from operations is also 3 billion. But there is no operational cash. Microsoft declaring income does not give us any cash. We are richer, but on paper. So we need to adjust the cash flows under the CFO. So we have an adjustment for a non-cash gain of minus 3 billion. The CFO is now 0. Under the asset side of the balance sheet, we increase our equity investments by 3 billion, which balances with the increased retained earnings of 3 billion. Now, Microsoft declares and pays dividends of 5 billion. We are happy, we have cash. But are we richer? Well, the answer is we are not richer. We should have been richer. I received the cash, why am I not richer? But the company I own has less cash. On balance, I am the same. I have more cash, but my investment is worth less. Because of this, we do not recognize anything on the income statement. This gets only a balance sheet treatment, skipping the income statement. We have more cash amounting to 3 billion, but our investment is less by 3 billion. So we reduce equity investments by that amount. The cash is classified as a cash flow statement from investments. Again, the treatment between IFRS and US GAAP is different. IFRS gives us the choice to classify dividends as operational or investment cash, while in the US it is classified as an operational cash. It makes sense that dividends from our equity investee does not result into wealth. Imagine you're a family and your sister gives you cash. As a family, you're not richer. You have more cash, but your sister is poorer. So the net wealth of the family is the same. What happens if the market value of Microsoft changes from 400 billion to 500 billion? Well, nothing. We do not care about market value changes. There is no accounting treatment for it. This is not a trading security. Renault does not care about the stock price of Nissan and how it changes on a daily basis. They have been owning Nissan for more than 20 years, and the investment is long-term. It is an alliance that hopefully benefits both. Short-term stock price changes are irrelevant. Trading securities and equity method investments are always in the news. Warren Buffett in 2022 got quite excited about Occidental Petroleum. Slowly started buying shares. At some point, they realized that they now own 20.9% of Occidental. It no more became a trading security. Actually, it became an equity method investment. So they had to change their accounting for it. They removed the item from trading securities and put it under equity method investments. Suddenly, stock price changes of Occidental became irrelevant to their own income statement. Instead, they now recognize 20.9% of Occidental profits as their own. To give you other examples of investments, I have the extract from Apple's 10K, where I showed the cash flows from investing activities. You can see 3 line items that are of importance to us. First is purchase of marketable securities. They have spent 109 billion buying trading securities for this year. They have 59 billion of marketable securities that have matured. These are bonds, where the bond is returned to the issuer and cash is given back to the investor. And 47 billion of sales of marketable securities, which is selling their investments for cash, I mean a liquidation. As you see, Apple has a lot of action when it comes to investments into trading securities. It buys and sells about 100 billion each year, a tremendously large amount. Well, if you're a $3 trillion company, they need to manage this cash effectively. Next, I show the extract of the balance sheet. You will see that Apple has two entries, one under current assets and another under non-current assets. The difference between them is duration. One is for less than 12 months, while the other is an investment for the longer term. You will see under current assets there are marketable securities worth 27.6 billion, which under non-current assets there is another 127.8 billion. The total is in excess of 180 billion. It is wise that Apple does not keep a lot of cash. As you see, only 34.9 billions. Since too much cash means that you are not creating any value. Cash has to be invested. And if there is no value-adding projects at the moment, you might as well put your money into short-term investments and wait for the good opportunity to come by. I finally show you an example from Renault's balance sheet to show you investments using the equity method. Here you will see under investments in associates and joint ventures, 16.2 billion for its investment into Nissan. They also have other associates that have a value of 721 millions. They specify in the balance sheet that there is a further details in note 12. Well, I also include note 12 here. You see that their share of Nissan's income is 380 million. This should be their 43% stake. To understand what is Nissan's approximate profit, you need to take the 380 and multiply it by 100 over 43, which is their percentage ownership.